See, Tyler, so you touched on something that I think we're focusing on quite a bit, which is that there's so much focus on growth as a weak growth as a trigger for Fed action. That material reassessment only applies to sort of the growth outlook. And unless things look like they're getting a lot worse, this Fed won't see a reason to cut. But as you noted, the inflation outlook here is important. I think Powell sort of reiterated that today when he said this Fed wants to resoundingly see inflation at 2%. And we haven't been able to get there. And the Fed, of course, is in the process of doing a monetary policy review where they're considering their approach and if they should be doing things differently. Should they be actually be looking even at times when the economy like now looks good to get inflation above 2%. That would mean changing the reaction function, potentially cutting rates, not for the economy, but to help inflation. So I think that there's a broader discussion here that the market isn't really focused on right now, but could be as we get into the summer.
Let me just quickly ask a dumb question for which I'm famous. Why do we need more inflation?
Well, we need inflation, I think, to be, we don't want inflation to be falling to the downside. I think that's really important. The Fed has shown, we all know, from looking at the global experience, if you get behind the inflation ball and you're getting disinflation, deflation pressures, that's extremely difficult for central banks. So we want to avoid that. So what the Fed is saying is, when you're in good times, there may be a case that you actually try to overshoot, to kind of build an inflation cushion. So when the inevitable downturn comes, you've built in some cushion and you protect yourself from that downside scenario unfolding. And I think this is what, what the Fed is talking about.
I don't know. I mean, Victoria, what do you think? Do you think that there's a point where the markets are ever going to be satisfied with not having access to super cheap money?
No, we have become so accustomed to having these low rates right now. I mean, you see the panic in the market when there's even the mention of rates moving higher. And I understand the fact that we want to put a floor under that inflation, and we want to try to get that to move a little bit higher and average around that 2%. But that whole Phillips curve phenomenon that we're used to seeing has really fallen apart recently. And so I'm not sure that lowering rates at this point is really going to help that inflation move higher. We haven't seen it. We have productivity actually moving higher than it's been in the last few years. That's going to keep unit labor costs low. So it's a very tricky line that they're trying to walk with the inflation and the rates. I want to talk a little bit about coronavirus here. And Michelle, I'm just wondering how coronavirus now factors into the inflation outlook.
Well, you know, again, it's just another factor that creates downside risk. And I think, you know, for the Fed that sees already concern about inflation not getting to 2%, and our forecast all year doesn't have the core inflation rate getting to 2%. Clearly, these developments, whether it's weaker global growth, the collapse in oil prices, all of this will only add to their concern that they won't be able to get to their 2% objective. And that's what I'm trying to say, too, is let's remember that could play as much into the Fed's decision as the weak growth outlook.
Is the weakest growth, to both of you guests, please, is the weakest growth likely to be in this first quarter and the economy then strengthening from there, or what? Victoria, you go first.
Yeah, I think we're definitely going to see a hit in this first quarter, especially if we have the factories and things in China continue to stay closed down. I mean, I think only about 10% of the workers right now are getting back to their jobs, and you have the huge issue with the migrant workers not being able to get there. Supply chains are going to be affected. The consumer is going to be affected. It's the degree that we see that happen that we're going to have to, be concerned with to see how much that knocks off GDP. If it's a quick turnaround, I think we see that small effect in quarter one, and that'll turn around in quarter two. If it's longer than that, if we're looking more like at the Japanese earthquake in 2011, it could continue on more towards the end of the second quarter, going into the second half of the year.
Tell me, Michelle, your thought. Does growth get better later in the year?
Yes, I think growth gets better later in the year. A couple things. First of all, I do worry about some of the spillover effects, that it isn't just going to be a Q1 story. If we're not talking about Chinese factories coming up online until April, May, and the lagged effects by the time it actually hits to, finds its way to the U.S., it could be a Q1, Q2 story for sure. I also think the other factor that bodes perhaps better for growth as we move into later in the year is uncertainty around the election. I mean, away from the coronavirus, the election uncertainty uncertainty, the possibility for, some binary outcomes depending on who may or may not be elected, who the Democratic nominee is, all of that could be a headwind for growth, and that uncertainty might get removed after the elections.